Shares in Royal Bank moving up after the company beat on profit in its latest quarter and also lifted the dividend. Let's get more on those results from Diana Avigdor, a VP, Portfolio Manager and Head of Trading at Barometer Capital. Thank you very much indeed for joining us, Diana.
Good morning, Andy. Thanks for having me.
Anything important with these Royal Bank numbers? Anything strike you as significant?
It was excellent, first of all, on all metrics. As expected, our premier bank in their capital markets and wealth management did really, really well. Capital markets, it's an obvious one. You just have to look at the TSX chart to show you how capital markets have done this year. And as Canada is trading at 52-week highs most days, not today, Canada has done very well, as have a lot of global markets this year. Relative to the U.S. have done much better. So capital markets, international component has done very well. But what struck me particularly great with Royal was their operating leverage of 8.1%. You recall what that is. It is how a change in revenue flows to the bottom line, direct profitability metric. At 8.1%, that is massive. Yes, the increased dividend. Generally speaking, these banks are our Canadian banks are well capitalized, so they're going to continue returning money and buybacks to their clients.
What about that low yield on Royal Bank, though? It's only 3%. And now I know they are increasing it, but compare it to, say, Canadian Natural Resources, an oil company. I know it's a special case. They have a rich dividend policy, but they're at a 5% yield.
I know, it's true. But they only started, our oil companies, actually, when you think about where oil is, we own Imperial Oil, for example. These companies are now throwing off really good cash flow. And they're very, very disciplined relative to, say, where they were 5 to 10 years ago. And that is the theme on the oil companies. And I would just say with Royal Bank or any of the Canadian banks, just look at their charts. As they go higher and higher, their yield is calculated as lower and lower. Both Royal and National increased their dividend. Maybe not by as much as you would like, but I think with a CET ratio of 13%, I think what you're going to see if they beat that, they're going to have more increased stock buyback and continued stability in increasing their dividend nice and slow.
What about National Bank? They, of course, are, now they're digesting two acquisitions, Laurentian's retail and business operations, and, of course, Canadian Western Bank.
Indeed. So their numbers were great, too. Their dividend increase, by the way, is probably lower than the market expected. Would have liked to see more. I kind of understand it and forgive it. They are trying and working to increase their presence, whether it's with Canadian Western Bank, which there are synergies, but maybe it's a little more nuanced there. We'll see on their call at 11 what they say. And, the Laurentian Bank portion of small business portfolio and retail, that's a nice little tuck-in. That should probably work, but it's a little more forgiven as we're going to give them the time ramp required to integrate and synthesize all these moving parts.
In the market right now, how are you playing it, Diana? Are you overweight cash, for example?
Yes, we are. So there's less than 20 trading days into year end. If you're a short-term trader, I think we're going to see increased volatility, as is normal during this time of the year. We've had a great year. Clients have had a great year. Everybody's in P&L protection mode, making sure that the volatility doesn't sink its teeth into your returns. And come another week and a half or two, liquidity is going to dry up, which makes the add-to-touch price movements a little more jumpy. So we are at around 20% cash.
Wow.
Our internal breadth indicators, our internal breadth indicators have started deteriorating about 2 months ago, perhaps. The volatility, I mean, last week the market rebounded after a pretty nasty week before. So basically, if you just look at indices and you didn't look at the 2 week move, you would have said nothing happened. But a lot of stocks traveled a lot of percentages in
Yeah.
order to show the flatness. So we'll see. If things get better, breadth gets better, we'll put money to work. But right now we have quite a lot of dry powder. And, it hasn't really hurt us, but it did decrease the volatility in the portfolios for our clients, which is probably desired.
There are fears, of course, that America's in the biggest bubble ever when it comes to this AI investment. Hundreds of billions of dollars have been talked about. Not all the money has been spent and may never be. But is there a risk that this could just make 99, 2000 look like just a mere bagatelle, and we're going to be in a much bigger blowout here?
Andy, I don't feel like we're in a big blow up. I do think that there's a lot of moving parts. Yes, the hyperscalers and their CapEx spending is now a theme. But if I step back and really step back, this AI story has a lot of tentacles. You look at employment, you look at companies benefiting, you're looking at productivity increases, you're looking at perhaps a rebuilding of the labor force. I mean, it is going to affect employment in some ways, replace. So I do think there is a lot of tentacles to this story. And one of the major ones is productivity, which offsets inflation. And so we can go on into this cycle a lot. NVIDIA reported a few weeks ago, and if they deliver on what they guided, they're only trading at 28 times forward earnings. We'll see.
I know it's fascinating times, Diana. We better jump. Thank you very much indeed.
Thanks, Andy.
Diana Avigdor of Barometer Capital Management.